question is, can you share any strategies for finding the best rates, mortgage rates, and terms for clients, particularly in the competitive market? I think that's what, almost.
Yeah, so before you even get to the rates, keep updated on the market, right? But beyond that, because when you start talking about rates, it can get dicey. Because if you can't do better than the competitive in terms of like the actual percentage, then you're kind of, then you have to work backwards. You gotta, drive out backwards instead of forward. So what I like to ask first and foremost, what's your budget, right? If you know the customer's budget, then that will help you from any objections that you have, because you can always say, it's in your budget. Know what whatever company you work for, know what sets them apart from the competitor, because when it gets down to interest rates and it becomes an issue, then you could say, okay, but we also have this benefit, that benefit, right? To bridge the gap. But for me specifically, we have exception processes. So we can say, okay, this other institution is offering this rate. This is the customer, this is their portfolio, right? And there's ways to get an exception. It doesn't always get you what you need, so that's why you have to be proactive and know what their budget is and know what else you can offer. Consider different amortizations, because different amortizations will impact the interest rate. And interest rate is really cost of borrowing. So what is it going to cost me to borrow this money, right? So if you can put money in their pocket in another way, you're directly offsetting the cost to borrow the money, right? So yes, people get caught up in that number, but if you could save them money in another way, your cost is lower. So what are we really talking about, right? Yeah.
Okay, I'm going to give you a slightly different approach, because your approach was more bank, in the bank space. And another thing I want to talk about too and draw attention to is every time people go through the mortgage course, they always feel that you're going to deal with buyers, okay? How are you going to get the buyers? How are you going to get your clients? I'm dealing with buyers. Well, I'm going to tell you something. There's more homeowners than home buyers. There's 9 million mortgages. 6 million of those, there's 9 million homeowners in the country. 6 million of those people own a home. So last year, there was about 600,000 people that purchased a home, but at the same time, there's 6 million people that own a home. So I deal with, at Matrix, we specialize in dealing with people that own a home that are looking to consolidate debt, refinance, renovate, put their kids through school, do a reverse mortgage. We specialize in that. And in that conversation, interest rate isn't really at the forefront. At the forefront of that is providing a solution. We have our own, at Matrix, our own private lending arm, and the rates in private mortgages are not the best. They're actually some of the worst, but they're not the worst. We're the best of the worst, but we're not the best, right? So if that makes sense, if you follow along, right? So our rates are slightly higher than the bank, but there's other people that are doing private mortgages that are higher than us. So we're on the lower end of the higher mortgages. A bank rate typically right now, I've seen BMO has 4.89 and 5.5. RBC called me yesterday with my mortgages, and I'm on a variable at 6.05, and they said, hey, you can lock in for 3 years at 5.5. I'm like, well, if RBC's calling me to lock in and I'm on a variable, that means the rates must be changing soon. They're trying to get ahead of it and lock me in. So I'm going to just stick with my variable, right? So, but the bank is offering me 5.5. On private mortgages, when I do mainly first mortgages, because of the exposure with seconds right now, if you guys are familiar with that, you could have multiple layers of mortgages. And those layers of mortgages have nothing to do with the size of them, but more so the time that they're registered. So if you register a mortgage at, right now it's 1122, and you register another mortgage at 1123, and they're both for 100,000, the mortgage registered at 1122 is a first, the mortgage registered at 1123 is a second. That's how it works. All right. So with that being said, we specialize in private first mortgages. Okay, and those rates start at 8%, right? So people come to us because their credit is shot, their income is shot. So you guys are familiar with the strategy of qualifying a mortgage with the 5 C's of credit, right? You guys know what they are? Tell me, what are they? And credit. So that's the foundation of getting a mortgage at the bank. But with me, all you have to have is collateral, which is the property, right? And that's about it. We don't really care about the credit. We don't really care about the income. We don't care about none of that other stuff. Just how much collateral do you have a property? And how much equity is in there? And then we go up to 80% of the value of the property, regardless if you have the income to pay for it or not. Right? Now they're trying to make it a little tighter and say you have to, make sure the mortgages are suitable, which is, I think, viable. It's a viable question. But for the most part, you could, offer prepaid mortgages and try to establish an exit strategy, which is getting harder to do because the market is getting very, very tight. And there's no exit strategy really at 80%. So now you have to look at the exit strategy and say, hey, what banks can I go to take me out of this mortgage? So that's something you have to look at as well. But with that being said, for us, we're more on the solution side. So you have to look at all viable options. So you have to say, okay, someone's coming to me with a mortgage at, let's say, TD, right, or RBC, and they're at 65% loan to value. You guys know what loan to value is, right? Value's 100,000, mortgage is 500,000. What loan to value are we at? Value's $1 million, mortgage is 500,000. What value are we at? Loan to value? $1 million, 500,000. What loan to value? I think you said it. If the value is $1 million on the property, and the mortgage is 500,000, what loan to value are we at? There you go. The value is $1 million, the mortgage is 650,000. What loan to value are we at? The value is $1 million, the mortgage is 650. What loan to value are we at? There you go. Done. All right. So. What this is important stuff. You have to be able to do these calculations in your head, right? No one's going to tell you to take out the mortgage calculator. I use my mortgage calculator. I have it on my phone. But if you could do it in your head, it's fast, right? So with us on the private side, and more and more get into that space, and you guys at level 1, you'd have to work with someone that's a level 2. Right, to put those deals through. But I think it's very important to understand the broad spectrum of the mortgage ecosystem, because you may talk to a client and because you feel that you're level 1, you can't have the conversation about a private mortgage, when you could technically have a conversation, but you can't fulfill the mortgage obligations to get them the mortgage. But you have to understand the whole scope, because if you don't do that, you're not going to be providing your clients with the best option, because your job and your fiduciary duty is to make sure that they have a suitable mortgage. Okay, so understanding the A space, the B space, and the private space is very critical. Okay, so with that being said, for us, we as in the private space, you have to know which banks are going to take you out if you put a person in a private mortgage. You have to know, okay, TD is going to refinance us to 80%, and all the banks are going to refinance you to 80%. So if you put someone in an 85% private mortgage, the only exit is to sell, and they may not sell because the market's going down and no one's buying. So then they could come back to you and say, hey, you put me in a mortgage that wasn't suitable. You see what I'm saying? So you have to know that stuff ahead of time. And number two, you have to document every conversation, whether it's a phone call, whether it's a verbal conversation, every conversation that you have with your client, you need to reduce that conversation to writing. Every single conversation, because if you don't do that, what's going to happen is 5 years down the line, when that client, can't get out of their mortgage because you put them in a first and second up to 90% or whatever it is, and they say, you made me in a bad situation, I need to sell. When it comes to court, they're going to come back to you, and they're not going to say, hey, let me see. They're not going to, say what's your side of the story. They don't want to have proof and documentation, and you need your clients to sign off on every conversation. So get in the habit of journaling. It's very, very important. Get into the habit of journaling every conversation. You might think it's boring, but it's to protect yourself. You have to do it. You have to have the paper trail. Every single conversation, journal it. Get into the habit of journaling, because right now it's a very tumultuous time. The climate is very, very, up in the air, and anyone's looking for somebody to sue, right? So just protect yourself. So that's what I have to say.